So today is a good day. We celebrate another 100% return on a stock. That's correct, another double up on a share price. And I think that puts us over 50 stocks now on this YouTube channel where I've talked about where stocks have gone and doubled, which is just absolutely phenomenal. And the thing is this stock is doing this in a bear market. We are in the worst stock market for 14 years and another 100% returner has been added to the list. It's another JKR smash out there. And the thing is, this video is going to split into two parts. I'm going to be talking about mentality for the first part. So even if you're not interested in the stock that I'm about to speak about, you might want to just stick around for a bit of a mentality and the stock market for the first few minutes. And then the second part will be about the stock and what to do now the stock is up over 100%, or what I'm going to do now the stock is up over 100%. So this stock here is a stock that received a lot of negativity. This was a stock that you would have seen it probably in the comments or any sort of chat rooms. You would have seen comments about, oh, it's a terrible stock. Even in the YouTube comments, you'd have seen people going, oh, it's down so-and-so, it's a bad stock, it's a bad pick, and talking a load of rubbish about it, talking about me being a load of rubbish, talking about the stock being a load of rubbish. And there was all in this negativity in this bear market, and it's been for multiple stocks, but this is one of the first few stocks that have kind of broken that trend and moved back into positive direction. And the reason why there was so many people being negative on this stock and talking bad about this stock isn't because the company was financially performing bad. This is a big thing. This is a big mistake that people make in the stock market. People sometimes talk about a stock or a business bad because the share price is going like this, and people see the share price going down like that and going, oh yeah, it's a bad investment. Look, the share price is down. The share price is down 50%. Of course it's a bad stock. You don't buy that stock, it's down 50%. And sometimes you can have stocks that are fundamentally performing absolutely amazing, and they do that, and stocks go down 50%. And we've witnessed it with loads of stocks in the last year. In this worst stock market for 14 years, we've witnessed a lot of stocks fundamentally go down like this. And people look at that fear, and people talk about that as being a bad investment. But it's not. As crazy as it sounds, the stock market gives you these opportunities. They give you opportunities sometimes where stocks where they are declining, but fundamentally, they're absolutely amazing. And this stock was one of them. This was one of the stocks that declined for absolutely no reason. And it was a stock that I was up on and it dropped massive. And people were saying, oh, now it's down so-and-so, clearly it's a bad stock. And rather than thinking, well, it shouldn't be down this much. It's actually buying opportunity. And from there, if you were, and I was, buying the stock in the dip, then you have had from only a few months ago a 100% return, which is absolutely amazing. And that's just a bit of a thing on a mentality. It's a prime example of what we're seeing on the stock market right now. And yeah, don't make this mistake where you see share price declines, but realistically, when you look at the fundamentals, they're just getting better and better in the key opportunities. And if you took this opportunity in this stock, you would have got the returns. But let's get stuck on to what's happening with this stock at the moment. So the stock is Card Factory. It's had a fantastic day, up 3% today. But on the last 5 days, it's up 18%. In the last month, it's up 24%. And in the last 6 months, it's up 96%, 100% return in 6 months. So I started buying this stock around these CV times, and originally I had a double up on this investment. I was up over 100% in 2021, and I did take a little bit of profit off the table, but I held it. I thought, you know what, it's still going to be okay in the long term. And then from there, the share price from around about May 2021 has been stuck in a massive decline, where the share price, for no reason, for the next month, just because we're in a bear market, it lost half its value, even though the stock and the business was performing fundamentally amazing. And it was only a matter of time, boom, before you finally have the pop-up. And the crazy thing is, we talk about this 323 million market cap company at 13 times earnings. The thing is this company's still not terribly valued. Even though it's already up 100%, it's not terribly valued. So you consider when it was half the value, then we're talking about how crazy it was. Now, as you guys know, Card Factory obviously sell the greetings cards, and there's many stores in the UK. If we go on the recent trading update on the 10th or Tuesday when it came out, they did an update after their busy period, obviously Christmas cards, the busiest period they have, and they said how well they were doing. Obviously, we got this a few months ago. They said before the Christmas trade that everything's going really well and it's looking promising. And then we've got an update afterwards. They said that we're trading ahead of expectations, good momentum across the business. They said they had strong revenue growth of 7.1% on a like-for-like basis. 7% like-for-like basis. That is unbelievable revenue growth. It shouldn't be this much. Like this, I thought this company was going to grow somewhere between 2-3%, maybe 4% at a push. unbelievable. This is like double my expectations, which is insane. He said that customers had returned to the high street because of the Royal Mail strikes. Obviously, sending cards through like a site like Moonpig, for example, is hard because obviously you might not get the cards because of the Royal Mail strike. So they benefited from that. Obviously, because they're cheaper as well. I'm sure that's helped them a little bit. And they said that the Royal Mail strikes did also hurt Card Factory's online growth. I do also think that was because mainly to the return in the high street. But we're not too fussed about that. It's still massively up compared to pre-pandemic levels, and we knew that was going to happen. But on to the key part as well about profitability. As a result of the trading momentum, EBITDA for the 12 months to the 31st of January 2023 will be at least 106 million. This EBITDA will be approximately profit before tax of around 48 million, which includes a 3.5 million of one-off benefits. So this is once again way ahead of expectations. And if we have a quick look on what they're saying on Outlook, they said that the board believes that the EBITDA for financial year 23 will be at least 406 million versus the current consensus of 96 million. Wow. Wow. That's a mega beat. And then they just finished to say that they are confident on the momentum that they're building. So obviously the financial performance has been unbelievable, and it was only a matter of time before it went on this run. And you can see here, still at this valuation, it's not too bad when you look at what they're doing inside the business. And then when you look inside the business, well, it was clearly obvious a few months ago when we mentioned insiders were loading up on the shares. Why were all the insiders loading up on the shares? Why was the new CEO, Darcy Wilson, that has been doing a fantastic job of turning this business around the last 2 years, why was he loading up shares? He was obviously really confident at 61p. Oh yeah, we are massively undervalued, and obviously getting the benefits from that. And the good thing as well is the only concern I ever had with this business was the debt. When I started picking up shares in 2020, I was like, oh, it's a little bit of a high risk play at the moment because of the CV situation. We don't know how it's going to go with the reopening. And then they made it to the other side, They started making good amounts of profit again. That wasn't a concern. They were staying open, and then because they were making good amounts of profit, they started paying down all the debt. They're now down to a 43% debt to equity, which is fantastic. And what we probably expect them to do in the next coming year is that, because if they're starting to make really good amounts of profit, 20 million, 30 million, up to 40 million in profit, what they're going to start doing is they're going to hopefully carry on paying down this debt even more, and this balance sheet gets better and better, which is obviously what we want them to do. So we're going to have good amounts of profit, revenue growth, profit to pay down the debt, absolutely fantastic. And the crazy thing is that potentially when they do strengthen this balance sheet up a little bit, what they're going to do? They're going to go back to a dividend. And for me, this is obviously one of the tricky parts, is that Card Factory used to pay quite a decent dividend. And if I get around about a 9p dividend, I'm going to be getting, well, on the current share price, you're going to be getting somewhere near a 10% yield. I don't think they'll go straight back to that dividend, but it shows you it's still a 10% dividend. And for me, for my average, I'm going to get a 20% dividend yield on this, which is absolutely crazy. That's more than the average return in the S&P 500 in 1 year. It's double the average return in the S&P 500. So for me, I'm like, well, I don't really want to sell it at the moment, because if they do go to some form of dividend, I'm going to be getting a chunky yield on this at the moment, which is fantastic. So you can see here, everything inside the business financially is performing absolutely amazing. Revenue ahead of expectations, profit ahead of expectations. They're paying down one of the main issues, which is the debt. Everything looks still strong to continue, because when you look at the environment, Royal Mail is still on strike, so anyone that's going to one of their main competitors, Moonpig, is still coming to Card Factory. You look at the spending cuts at the moment and people looking to reduce the spend, they're going to Card Factory to go pick up the cards instead of maybe going to a bit more of an expensive place to buy cards. So they're getting that trade, and that trade still looks like it's going to continue going forward. You start factoring the dividend yield. I could potentially looking at least a 10% dividend yield if they return that dividend after they strengthen that balance sheet up a little bit, up to a 20% dividend yield if they're going off the old one before we got to the CV times. It's absolutely fantastic. So for me, I'm personally at the position where I probably will look to sell maybe 10 or 20% of my position. I did that last time I was up over 100% return, and that looked like the right decision, because obviously then the shares did crater, and then I was able to pick up them shares again back at some really good prices. But that might not happen again, but I think it's always good to take maybe a little bit of profit off the table. Why do we invest in stock market? We invest to make money, so it makes sense for me to take some of my money, some of my profit off the table, and go invest it in somewhere else. But there's also a good chunk of Card Factory that I'm holding at the moment where I'm like, I might as well keep it in here. You know, it's not an expensive stock. If I look in the future still looks good. I'm probably going to get a dividend that comes back soon, and I'm going to get a really good yield from that dividend. So for me, I do look at it like it might be worth taking some profit off the table, but also when I look at the future, it's still a pretty exciting future in the next coming year. So that's probably what I'm going to do with Card Factory. The only thing that would change my mind is if we go from where we're at now and then we double up again. Come back to me if it doubles up again, because then my opinion might change what I do with the share price on my position that I do own. But that's my plan at the moment. Now, very quickly, I do want to point this out. Now, obviously, Card Factory has had some benefit because of people going to them and probably taking a few customers away from Moonpig. Now, Moonpig, I think, is still a good business. But if you look at the share price, this has absolutely declined massively because they've been hurt because of the Royal Mail strikes. And also they've had people not wanting to spend as much as on Moonpig. Obviously, it's a little bit more expensive. So my little thought on the background now is that I still want to be in Card Factory, but Moonpig is starting to come interesting. When we see maybe some of these Royal Mail strikes resolved, if we see consumer environment, the spending return a little bit in the UK market, Moonpig might be an equivalent turnaround play to where Card Factory was 2 years ago. So I think Card Factory is still doing really well and they've got a good future for it. But I'm just showing you a stock that I have now identified as potentially a future Card Factory, one to add on the watch list and maybe check back in a year's time. But yeah, Moonpig, if them problems do start to resolve themselves, could be Card Factory Part 2. So I'm just going to put that one out there, one to stick on your watch list for the next year. So I hope you enjoyed the little update into Card Factory, guys, and well done to you guys that have been buying some shares in that one or bought the dip in that one and got the returns and potentially hit another 100% bagger. Hope you enjoyed the video. If you do want to know what I'm buying and selling in real time and also have 2 exclusive videos a week, the link is in the description to join through the Patreon. But as always, see you in a bit.